India's economy was worth 350 lakh crore rupees in 2025. And when we say economy, we mean GDP. This GDP is quite a brilliant little thing. I mean, it's a single number that captures literally all the activity in the country. Whether it's sales from IPL tickets in Jaipur, biscuits being sold in Pune, the setting up of a new factory in Chennai for manufacturing the latest mobile phones. Every single activity. And then we distill all of this into a single figure. So in this video, I'll tell you two things you should know about GDP. Number one, how is India's GDP calculated? And number two, what is the difference between nominal GDP and real GDP? But before I do that, I should actually tell you why you should care about the GDP. See, while the 350 lakh crore number that I mentioned at the very start is the value of the economy or the GDP, what we usually see in the news is a percentage. And that is what tells all of us how fast or not the economy is growing. If you plot it on a graph, it looks something like this. Up sometimes, down the other times. All depending on how many activities occur and what is the value of those activities quarter after quarter, year after year. Sometimes, if you get 2 quarters of negative GDP growth, then everyone calls it a recession. But anyway, this chart or the GDP growth, it affects a lot of things. The government will look at it to decide whether they should spend more money to spur growth. The Reserve Bank of India or the RBI, they might tweak the interest rates in the country based on it. And even foreign investors, they will consider the GDP number before making a new investment or setting up new factories in the country. Now sure, as ordinary citizens, we aren't making any such policy decisions. So we don't really need to know everything there is to know about how it is calculated. The number alone, that GDP number alone, that should be enough for us to know what to feel. A high GDP, we should feel happy. A low GDP, sad. But it doesn't actually hurt us to know a little bit more about GDP because it affects the stock market movements and even the rate of interest that you pay on your loans. So let's dive into that. There are 3 ways in which GDP is typically calculated. And each of these methods, they are supposed to give you a very similar GDP output. The first and probably the most popular way of explaining GDP is the expenditure method. We look at all the spending in the economy, whether it's consumption by people like you and me when we buy biscuits or get a haircut, government expenditure on roads, investments made by the corporate sector, say in setting up a new factory, add all the exports and deduct the imports. And we get the GDP. This is what the formula looks like. GDP equals consumption plus investment plus government spending plus exports minus imports. And in many economies, consumer spending, or that C, is what drives the GDP. Nearly half of GDP is a result of the billions of decisions that people like you and me make on a daily basis. In India, C drives over 60% of the GDP. Also, in countries which run a trade deficit, where the exports are less than the imports, that final part of the equation is usually a negative figure. And this is the same story for India too. Another way to estimate GDP is through the income method. This sums up all the compensation earned by employees and the gross operating surplus of companies. Now this is essentially what is left of corporate revenue after employee compensation and taxes on production such as excise duties. Or another crude way of thinking about this is by taking into account what economists call the 4 factors of production. We are talking about land, labor, capital, and entrepreneurship. For instance, let's take a car company as an example. Say a landowner has leased out the land to manufacture the cars and earns rent on it. That's income earned on the land. Then there's a person working on the factory floor and assembling the doors and windows of the car. They earn a monthly wage for their work. That's labor. Next is capital. This could be money that's lent by banks to set up the factory, and they earn interest on it. Or it could be the shareholders who have invested in the company and earn a dividend. Finally, there's entrepreneurship, which in this case is what's left over for the business owners after everyone else is paid. That's their income. Anyway, you add all these up and you get the GDP through the income approach. Basically, instead of looking at what people spent, like in the expenditure method, we are now looking at what everyone earned to produce those goods and services. Because if you think about it, every rupee that's spent becomes a rupee of income for someone else. And finally, you could also calculate GDP through the output or production method. And I think that is a little bit more intuitive for our breakdown now. Because here, the focus is not on spending, but on the aggregate value of goods produced in the country. We simply sum up the total values for all the final goods and services, like cars, cell phones, bananas, to get the final total value, which is GDP. A crude way of laying out the formula for this is like this, which is basically the sum of price into quantity. Simple. Actually, to tell you the truth, it is a little more complicated than that. So let me give you an example that will hopefully tell you why. Now imagine a simple economy that only produces bread. So stage 1 is farming, where there is a farmer who is selling wheat for, let's say, 100 rupees. There is no intermediate cost over here, and the value added is directly 100 rupees. Stage 2 now is when the wheat goes for milling. The miller converts the wheat into flour and sells the flour for 150 rupees. In this case, the intermediate cost is 100 rupees and the value that's added between the stages is 50 rupees. And now in the third stage, the flour goes to the baker who converts it into bread. And let's say he sells the final loaf of bread for 250 rupees. The intermediate cost in this case is 150 rupees, but the value added from the previous step is 100 rupees, giving you a grand total of 250 rupees as the total value added. So, by only considering the value added at each step, rupees 100 plus rupees 50 plus rupees 100, we arrive at the final GDP of 250 rupees. If we had simply added the sales prices of the wheat, flour and bread, we would have incorrectly calculated a GDP of 500 rupees. Now that we have broken down the different ways by which we can calculate GDP, let's use the output method itself, or the crude version of it, which I think is very intuitive to understand the difference between nominal GDP and real GDP. To get nominal GDP, all you do is take the quantity of everything produced in the country and multiply it by their current price. So it's the sum total of current price and the quantity. But there's a little problem with this, the problem of comparison. Now say you want to compare the GDP of 2025 with that of 2023. How do you know if the nominal GDP rose because the quantity produced was higher or because the price for everything was higher? Because if the prices have shot up, everything will look bigger. Take the example of a bike manufacturer who made and sold 100 bikes for 1 lakh rupees in 2023. That's a total of 1 crore rupees worth of bikes. Then in 2025, they sold 102 of the same make and model for 1.3 lakh rupees. The total in this case is a little over 1.3 crore rupees. The total is higher, but you'll notice that it has been primarily driven by an increased price and not because of an increased quantity that's been produced. So we need to understand how much the economy has grown, not because the prices are pushing the GDP higher, but because we produced more goods and services. And that is where real GDP comes in. We can adjust the nominal GDP for inflation to reveal how much of that expansion is driven by actual economic activity rather than rising prices. And if I put it into an equation, I will get real GDP equals the sum total of price into quantity divided by the price index. So when you see the newspaper reports of GDP growth rates of 7%, 8% or some such number every few months, it's the real GDP growth they're talking about. It's usually only in the budget documents that you see the government mention nominal GDP. And the nominal GDP growth for a country like India is anywhere between 10 to 12%. A simple way of thinking about it is nominal GDP equals real GDP plus inflation. So that 350 lakh crore rupees I mentioned at the start, that's the nominal GDP value of India in the financial year 2026. The real GDP value, on the other hand, is just about 200 lakh crore rupees. But just going back to that earlier formula for a minute, that price index you see in the denominator, that's called the GDP deflator. It is called a deflator because it brings the GDP back down to sensible inflation-adjusted levels, and it makes comparisons easier. If you take the example of the bike as being representative of the GDP, after adjusting for inflation, the real GDP could be 1.1 crores and not 1.3 crores. So there you have it. A quick primer on what is GDP, the difference between nominal and real GDP, and the 3 most common ways to calculate it. And if you have any thoughts, questions, or comments, drop them below. We'll see you soon in the next video.